Hey, buddy, come in. You're such a good dog. On the first day of April 2026, a man named Nefouse sat in front of a camera at Fox Business and said something that most people in the financial media treated as a routine policy update. Nefouse is not a trader, not a crypto influencer, not a Bitcoin evangelist. He is the global head of retirement solutions at BlackRock, the world's largest asset manager, with more than $10 trillion under management, responsible for the retirement savings of millions of Americans through target date funds, 401k plans, and institutional portfolios. What he said on Varney and Company that Tuesday morning was precise, documented, and almost nobody who holds a 401k account heard it. He said this: think of regular people. About 25% of the population are in defined benefit plans. About 80% are in defined contribution plans. What we are trying to do is level the playing fields, and so many Americans are relying on 401k plans. 80%. That number is not a projection or an estimate. It is the documented structure of how retirement savings in America are organized, confirmed by the Investment Company Institute, which reported that defined contribution plan assets reached $14.2 trillion as of December 31st, 2025, out of a total U.S. retirement market of $49.1 trillion. 90 million Americans hold 401k accounts. 30% of U.S. registered voters have no retirement savings at all, according to a BlackRock survey of 1,000 registered voters conducted in January 2026. And of those who do have retirement savings, 63% have less than $150,000 saved, which is approximately 7% of what the average American now believes they need to retire comfortably.
Hi guys! Enjoy John's analysis.
The reason this channel is covering this story right now is not because Bitcoin had a good week. It is not because the price moved. It is because on March 30th, 2026, 72 hours before Nefouse appeared on Fox Business, the United States Department of Labor published a proposed rule in the Federal Register that could change the legal architecture of what those 90 million Americans are allowed to hold inside their retirement accounts. The rule is titled Fiduciary Duties in Selecting Designated Investment Alternatives. It creates a process-based safe harbor for retirement plan fiduciaries who want to add alternative assets, including cryptocurrency, to 401k plan menus. And it follows directly from an executive order signed by President Trump on August 7th, 2025, directing federal agencies to expand access to alternative assets in retirement plans governed by ERISA. This video is going to explain exactly what that means, why the mechanism that could bring Bitcoin into 80% of American retirement portfolios is already in motion, and why most of the people whose retirement savings are about to be affected have no idea it is happening. If you want to know how to buy Bitcoin before this catalyst fully activates, this video builds the framework. If you want to understand why BlackRock is calling this a huge step forward and what it actually does to the 401k market, this video is for you. No price targets, no financial advice. Just the structure of what is being built right now in real time while the financial media covers the Iran war and the markets watch the Fed. To understand why the 80% number matters, you need to understand a distinction that most Americans have never had to think about, because for most of their working lives, it did not affect them. There are two types of employer-sponsored retirement plans in the United States, and they are structurally different in a way that matters enormously for what is about to happen. The first type is called a defined benefit plan, what most people simply call a pension. The second type is called a defined contribution plan, which includes the 401k, the 403b, the 457, and several other account structures. These two plan types do not just differ in name. They differ in who bears the risk, who makes the investment decisions, and, critically, who has access to what assets. In a defined benefit plan, your employer makes the investment decisions. The company, the government agency, or the institution promises you a specific monthly payment in retirement, a defined benefit, based on your years of service, your salary history, and a formula the plan determines. You do not choose where the money is invested. You do not pick the funds. You do not decide the allocation. A professional investment committee manages the portfolio on behalf of all participants, and that committee has access to a much broader menu of assets than the average worker ever sees: private equity, real estate, infrastructure, and increasingly, digital assets, including Bitcoin. According to a white paper by a Marquette University professor analyzing financial filings for 17 of the largest U.S. public pension systems, these funds already held $3.32 billion in cryptocurrency-linked equities and ETFs as of mid-2025. In a defined contribution plan, you are the decision maker. Your employer offers you a menu of investment options, typically a selection of mutual funds and target date funds, and you choose where to put your contributions. The employer may match a portion of what you contribute, but the investment choices are yours to make. The account balance at retirement reflects whatever those investments earned or lost minus fees over the course of your working life. And crucially, you're only able to invest in what your plan sponsor puts on the menu, which, until very recently, has been stocks, bonds, and mutual funds. No private equity, no real estate, no digital assets, no Bitcoin. This is the gap that Nick Nefouse was describing on Fox Business. The IRS defines both plan types clearly, and the data from the Investment Company Institute confirms the scale of the imbalance. Defined contribution plan assets reached $14.2 trillion at the end of 2025, according to ICI's Q4 2025 report, the most current data available. Government-defined benefit plans held $10 trillion. Private sector defined benefit plans held $3.1 trillion. 90 million Americans hold 401k accounts under the defined contribution framework, the framework where they bear the risk and the framework where their investment menu has historically been the most restricted. The structural injustice that Nefouse was identifying is not subtle. If you work for a large company or a government agency and you are in a pension, the defined benefit side, your retirement money has already been able to access alternative assets, including cryptocurrency-linked investments, through the professional fiduciaries who manage those funds. Wisconsin's State Investment Board disclosed $187 million in Bitcoin ETF holdings in 2024. Michigan holds $11.4 million in Bitcoin exposure. A UK-defined benefit pension trust made the first ever Bitcoin allocation within a corporate pension in 2024, recording a 76% return on that allocation between October 2024 and October 2025, according to Cartwright's annual review. The workers in those pension systems never had to make a single decision about Bitcoin. Their professional investment committees made it for them. The workers in 401k plans, the 80%, were not allowed to participate in that upside, even if they wanted to. They were locked into a menu that reflected a legal framework built for a world where mutual funds were the most complex investment product most Americans could access. That framework is what the Department of Labor proposed rule, filed in the Federal Register on March 30th, 2026, is designed to change, and the mechanism through which it could affect 80% of Americans without most of them ever making a conscious decision is the one this channel is going to explain in the next blocks, and it is called a target date fund. Before this video explains what is being built, it needs to explain who is building it, because the identity of the institution matters as much as the proposal itself. BlackRock is not a crypto company. It is not a fintech startup. It is not a Bitcoin advocate trying to convince the establishment to pay attention. BlackRock is the world's largest asset manager, with $14 trillion in assets under management as of the end of 2025, according to its own annual report, a figure larger than the GDP of every country on Earth except the United States and China. It manages money for pension funds, sovereign wealth funds, endowments, insurance companies, and central banks across every continent. When BlackRock's global head of retirement solutions sits in front of a Fox Business camera and calls a Department of Labor rule a huge step forward for the 401k market, he is not doing so as an advocate for a new asset class. He is doing so as the fiduciary representative of the institution that manages more retirement savings than any other entity on the planet. Understanding how BlackRock got to this moment requires understanding how dramatically its own position on Bitcoin changed between 2017 and 2026. In 2017, Larry Fink, BlackRock's chairman and CEO since he co-founded the firm in 1988, called Bitcoin an index for money laundering and thieves. That quote circulated in the crypto community for years as the definitive statement of establishment finance's contempt for digital assets. By 2020, Fink acknowledged Bitcoin as a global asset. By 2021, he referred to it as digital gold. By 2024, his firm filed for and received SEC approval for the first BlackRock spot Bitcoin ETF, the iShares Bitcoin Trust, ticker IBIT, which Fink himself described on a Fox Business appearance as the fastest growing ETF in the history of ETFs. The evolution was not an accident of changing market conditions. It was a deliberate, years-long reassessment by the world's largest asset manager of what Bitcoin actually is and what role it should play in a diversified institutional portfolio. IBIT became the most remarkable ETF launch in financial history by any objective measure. The fund reached $10 billion in assets under management in just 50 days after launch, faster than any ETF in history had reached that milestone. It reached $50 billion in 341 days. By October 2025, it had crossed 800,000 Bitcoin, 3.8% of Bitcoin's entire 21 million coin supply, representing over $100 billion in assets at peak valuation. Net inflows into IBIT alone exceeded $65 billion in its first year, and the fund became BlackRock's top revenue-generating product, according to Cristiano Castro, BlackRock's Director of Business Development in Brazil, speaking in November 2025. By the end of 2025, BlackRock had nearly $150 billion in digital asset-connected assets under management across IBIT, its Ethereum ETF, its tokenized money market fund, BWIDL, and related products. But the most significant signal from BlackRock was not the ETF. It was Larry Fink's annual chairman's letter to investors, published on March 23, 2026, 8 days before Nick Nefouse appeared on Fox Business. In that letter, Fink warned explicitly that if the United States does not get its debt under control, if deficits keep ballooning, America risks losing the dollar's world reserve currency status to digital assets like Bitcoin. He framed decentralized finance as an extraordinary innovation that makes markets faster, lower cost, and more transparent. He simultaneously described BlackRock's own digital asset businesses as proof that institutional capital was not just observing this transition, it was actively building the infrastructure for it. The letter was not a promotional document for Bitcoin. It was a strategic reading of the monetary system from the CEO of the firm that manages more of the world's retirement capital than any other institution. And it pointed explicitly toward a world where Bitcoin's role in portfolios is not optional or experimental, but structural and necessary. The bear case on BlackRock's involvement deserves honest treatment. BlackRock profits from IBIT through a 0.25% management fee on assets that reached over $50 billion, generating an estimated $245 million in annual fees by October 2025. The firm profits from the growth of crypto-connected AUM, from its BWIDL tokenized fund, and from the broader regulatory environment that its own lobbying and advocacy helped shape. When Fink warns that Bitcoin could undermine the dollar, he is simultaneously the CEO of the world's largest Bitcoin ETF issuer, a conflict of interest that critics note is not subtle. The Economic Policy Institute has argued that BlackRock's push for alternative assets and retirement accounts serves the firm's fee revenue interests as much as it serves retirees' financial security. These criticisms are structurally valid, and this channel does not dismiss them. What this channel observes is that the conflict of interest does not invalidate the structural argument, and that when the world's largest asset manager, the world's most profitable Bitcoin ETF, and a Department of Labor proposed rule all converge on the same direction in the same 30-day period. The direction of travel is worth understanding regardless of who profits from it. Okay, quick pause. If you're watching this and you've already reached the 10-minute mark, give yourself a pat on the back. Most people don't make it this far. The fact that you're still here shows real discipline and genuine interest in understanding how these big structural shifts actually work. That's rare, and I really respect that. Quick favor. If you're enjoying this video so far, please hit the like button right now. It helps a lot and tells me which topics you want to see more of. And if you haven't already, go ahead and subscribe. Plus, turn on notifications so you don't miss the next videos in this series. Now, let me know you're here and committed. Drop a comment with exactly these 3 things: your city and country, what time it is there right now, how the weather is over there. I read every comment, and I love seeing how global this community really is. People watching from all over the world at completely different hours. It's one of my favorite parts of making content. So go ahead and comment right now. I'll be waiting to read yours. Okay, let's continue. There's a conversation happening at the highest levels of American institutional finance that almost never reaches the people it is actually about. And it is not about Bitcoin. It is about whether the American retirement system can continue to function as currently designed and whether the assets it holds are sufficient to deliver the outcomes it promises. Larry Fink opened his 2026 annual letter to investors with a personal story about his parents, a shoe store owner and an English teacher who invested modestly in American equities during the 1950s and 60s and retired comfortably because their savings compounded alongside the American economy. He used that story to set up what he called the defining financial challenge of the current era, the gap between the people who own assets and the people who do not, which AI and the current structure of capital markets are widening at an accelerating pace. The core problem, as Fink framed it, stock market wealth has grown 15 times faster than median wages since 1989, and roughly 40% of Americans still have zero exposure to capital markets at all. BlackRock's own survey data, conducted by the independent research firm Public Opinion Strategies in January 2026, documented the scale of the retirement shortfall with precision. 30% of registered U.S. voters have no retirement savings whatsoever. 63% have less than $150,000 saved, which is approximately 7% of the $2.1 million that the average American now believes they need to retire comfortably. The survey was not cherry-picked by a sensationalist publication. It was commissioned by BlackRock, released by BlackRock, and discussed by Larry Fink in his annual letter as the primary empirical justification for why the retirement system needs structural reform. For context, Fidelity's retirement advice suggests saving 10 times your annual salary by age 67, meaning a person earning $100,000 should have $1 million by retirement. The gap between $1 million and what 63% of Americans have saved is not a minor planning shortfall. It is a structural failure that the existing 401k framework, invested almost exclusively in stocks and bonds, has not been sufficient to close. The problem is not simply that Americans are not saving enough, though that is part of it. The deeper structural problem is that the investment menu available to most 401k participants has historically been designed around a risk-return framework that made sense in the 1990s, but is increasingly inadequate in an era of chronic fiscal expansion, elevated inflation, and compressed bond yields. Bonds were the traditional ballast of retirement portfolios, the asset that was supposed to protect capital as participants approached retirement. But since 2020, U.S. government bonds have delivered some of the worst real returns in their history. The Bloomberg U.S. Aggregate Bond Index fell over 13% in 2022, the worst calendar year performance for bonds in a generation, while consumer inflation ran at over 8%. The workers who were closest to retirement in 2022, the ones who had dutifully shifted their 401k allocations toward bonds as their target date approached, experienced the worst of both worlds, inflation eroding their purchasing power, while the very assets they had been told would protect them declined in market value simultaneously. Defined benefit plans, the 25% of workers who still have pensions, did not face this problem in the same way. Their professional fiduciaries had already diversified into private equity, private credit, real estate, infrastructure, and other alternative assets that provided uncorrelated returns and inflation protection during exactly the periods when public bonds failed. According to BlackRock's own institutional research, DB plans have historically outperformed DC plans by approximately 50 basis points per year on a risk-adjusted basis, primarily because of their access to private markets, which DB participants can allocate approximately 16% of assets to on average. Over 40 years of compounding, 50 basis points per year becomes approximately a 15% improvement in final savings outcomes. 15% more money at retirement is not a rounding error. For a worker with $500,000 in savings, 15% is $75,000, roughly 3 to 4 years of additional retirement security. The structural advantage of defined benefit participants over defined contribution participants is not theoretical. It is documented, quantified, and the direct result of an access gap that the DOL's proposed rule is designed to close. This is the context in which Bitcoin's potential inclusion in 401k menus needs to be understood, not as a speculative bet on a volatile digital asset, but as one component of a broader restructuring of the retirement investment menu toward the asset classes that have historically produced better outcomes. BlackRock's December 2024 paper, Sizing Bitcoin in Portfolios, made the specific mathematical case. A 1 to 2% allocation to Bitcoin in a 60-40 portfolio produces approximately the same contribution to overall portfolio risk as the average Magnificent 7 technology stock, while potentially providing a source of return that is uncorrelated with equities and bonds over the long term. The key phrase in that analysis is potentially uncorrelated, because Bitcoin's correlation with equities has been inconsistent, and 2022 demonstrated that during Federal Reserve tightening cycles, Bitcoin can fall alongside equities rather than providing the diversification benefit the thesis promises. This is the bear case that every honest analysis of Bitcoin in retirement accounts must include. The structural urgency is real, and the data is unambiguous. 63% of Americans have under $150,000 saved. The existing bond-heavy default menu has underperformed in inflationary environments. Defined benefit participants have structural access advantages that defined contribution participants do not. And the DOL's proposed safe harbor rule is explicitly designed to level that playing field. Whether Bitcoin is the right asset to fill part of that gap depends on a question that no institution can answer definitively. Whether its correlation properties over the next 30 years will more closely resemble the uncorrelated digital gold thesis or the high beta technology risk asset that it has sometimes behaved like over the past 4 years. The honest answer is that nobody knows, and the fiduciary framework being built around the safe harbor is designed precisely to allow plan sponsors to make that determination through a documented analytical process, rather than having it made for them by a regulatory environment that either prohibited Bitcoin or permitted it unconditionally. That is the structural significance of what was published in the Federal Register on March 30th, 2026. One final data point anchors the urgency of the retirement crisis in a way that makes the policy response comprehensible. Social Security's trust fund is projected to be depleted by 2033, according to the program's own trustees, at which point benefits would automatically be cut by approximately 23% unless Congress acts. Larry Fink raised this issue directly in his 2026 annual letter, proposing an optional diversified investment component for Social Security modeled on the federal thrift savings plan with a $1.5 trillion upfront commitment and a 75-year investment horizon. He cited Australia's superannuation system and Japan's NISA investment accounts, which added 10 million new investors and contributed to the Nikkei's rise from 28,000 to 50,000 as evidence that national investment accounts can improve retirement outcomes at scale. The point is not that Bitcoin belongs in Social Security. The point is that the highest profile voice in institutional finance is publicly arguing that the existing retirement architecture is structurally insufficient and that alternative assets, including digital assets, belong in the conversation about how to fix it. When the CEO of the world's largest asset manager is making that argument in his annual letter to investors, the question of whether Bitcoin ends up in your 401k is no longer a question about whether the establishment accepts Bitcoin. It is a question of when the legal infrastructure catches up to the institutional conviction that already exists.
Hey guys, I need a quick favor from you. If you're enjoying this video, please smash that like button and hit the hype button after. It really helps the channel grow and tells the algorithm that this kind of deep macro plus Bitcoin content deserves to reach more people. Takes literally 2 seconds, but makes a huge difference for us. See you.
Most people who saw the BlackRock headline on April 1st heard a single data point and moved on. They heard that 80% of Americans might get Bitcoin in their 401k plans, and they filed it under the category of things that might happen someday, like flying cars or Social Security solvency. What they did not hear, because almost no one explained it, is that April 1st was not the beginning of this story. It was the last link in a chain of regulatory events that stretches back 8 months and accelerated dramatically in the 30 days before Nefouse sat down in front of that camera. Understanding that chain is what separates people who know what is being built from people who will read about it in a headline 2 years from now and wonder how they missed it. The chain begins on August 7th, 2025. That is the date President Trump signed Executive Order 14,330, formerly titled Democratizing Access to Alternative Assets for America's Workers. The order directed the Department of Labor to relieve the regulatory burdens and litigation risks that had prevented defined contribution plan fiduciaries from seriously evaluating alternative assets, including cryptocurrency, private equity, real estate, and infrastructure. It did not mandate Bitcoin in your 401k. It directed the agencies to clear the path. Before this order, the regulatory barrier was not statutory. Plan fiduciaries had always had the theoretical legal authority to consider alternative assets. The barrier was liability. A Biden-era 2022 compliance release had urged plan managers to exercise extreme care before offering cryptocurrency, effectively signaling that any fiduciary who included Bitcoin would face enforcement scrutiny regardless of whether their decision was prudent. The second link arrived on May 28, 2025. The Department of Labor's Employee Benefits Security Administration issued Compliance Assistance Release number 2025-01, which rescinded the Biden-era extreme care guidance in full. The DOL stated explicitly that the extreme care standard had gone beyond ERISA's ordinary fiduciary principles, returning to what the department called its historical neutral approach, neither approving nor disapproving of cryptocurrency as an asset class. That rescission cleared the first structural obstacle. Plan fiduciaries could now evaluate Bitcoin the same way they would evaluate any other investment option, through a documented prudence review, subject to the same facts and circumstances standard that governs every other asset on the plan menu. The third link arrived on March 17, 2026, 13 days before the DOL rule was published. The Securities and Exchange Commission and the Commodity Futures Trading Commission issued a joint 68-page interpretive guidance that officially classified 16 major cryptocurrencies as digital commodities under federal law, not securities. The list includes Bitcoin, Ethereum, Solana, XRP, Cardano, Avalanche, Chainlink, Dogecoin, Litecoin, Polkadot, Hedera, Bitcoin Cash, Shiba Inu, Stellar, Tezos, and Aptos. SEC Chairman Paul Atkins described the move as finally delivering the clarity that the industry had been requesting for more than a decade. calling decades of regulatory turf wars between the two agencies the primary obstacle to institutional adoption. CFTC Chairman Michael Seelig called it the foundation for a harmonized framework that modernizes oversight to match how markets actually operate. For the DOL's proposed safe harbor, this classification was critical. A fiduciary conducting a prudence review for Bitcoin or Ethereum can now document that process with full legal confidence about the asset's regulatory status. The fourth link arrived on March 30th, 2026. The DOL published its proposed rule in the Federal Register, the one that created the six-factor process-based safe harbor for fiduciaries who add alternative assets to their plan menus. The rule is asset class neutral. It does not name Bitcoin, does not endorse any specific investment, and does not require any plan to add anything. What it does is remove the personal liability exposure that has historically made the question academic for most plan sponsors. Under ERISA, fiduciaries who make investment decisions that result in losses can be held personally liable. That exposure kept the vast majority of plan sponsors away from any asset class perceived as unconventional, regardless of whether it served participants well. The proposed rule changes that calculus by establishing that a fiduciary who follows the documented six-factor review process, covering performance, fees, liquidity, valuation, performance benchmarks, and complexity, is presumed to have met their duty of prudence under ERISA, Section 404(01)(b). According to CoinSpeaker, the rule potentially unlocks an $8.8 trillion participant-directed retirement market spanning roughly 721,000 plans. The fifth link arrived on April 1st. Nefouse on Fox Business, the world's largest asset manager, telling a national television audience that a huge step forward for the 401k market had just been taken. What he did not say, because it is not his job to say, is that this was not the announcement. This was the endorsement. The announcement was a chain of regulatory events that had been building for 8 months, connecting an executive order to a guidance rescission, to a landmark SEC CFTC commodity classification, to a proposed rule published in the Federal Register. Every piece had to be in place before the safe harbor made legal sense. Every piece is now in place. There is a sixth link that most coverage of this story has ignored entirely, and it is the one that makes the legal architecture of the safe harbor actually workable in practice. On March 4th, 2026, Kraken became the first crypto-native firm to obtain a Federal Reserve master account, a banking relationship that had previously been available only to traditional banks, and that gives Kraken direct access to the Federal Reserve payment system. The significance for 401k adoption is specific and structural. Plan fiduciaries evaluating Bitcoin under the six-factor safe harbor must assess the custody and infrastructure quality of any digital asset they add to a plan menu. The existence of a crypto-native firm with direct Fed access, combined with Coinbase Custody's role as custodian for BlackRock's IBIT, Fidelity's long-standing digital assets custody infrastructure, and the SEC CFTC commodity classification that removed the legal overhang on holding Bitcoin in regulated accounts, means that the custody infrastructure question, which was a genuine open problem as recently as 2022, is now answered. The barrier was never the asset. The barrier was the legal and institutional scaffolding around the asset. In March 2026, that scaffolding was completed. What the convergence of these six events in a single 30-day window represents is not an accident of regulatory timing. It is the culmination of a years-long coordinated process between the executive branch, the SEC, the CFTC, the DOL, and the largest financial institutions in the world to create the conditions under which institutional retirement capital could flow into Bitcoin through regulated, auditable, legally defensible channels. Treasury Secretary Scott Bessent emphasized at the time of the DOL rules publication that the proposal is an initial step toward expanding retirement investment access while maintaining safeguards, language that signals this is not the end of the regulatory development, but the beginning of a formalization process that will take the remainder of 2026 to complete. The comment period closes around June 1st. The final rule is expected in Q3. Implementation begins in Q4 or early 2027. The clock is running. The question for every person who holds a 401k account or who is thinking about whether to buy Bitcoin now, before that clock completes, is whether they want to understand the architecture before it activates or after. Okay, quick disclaimer. The macroeconomic and geopolitical analysis in this video is strictly for educational purposes and does not constitute financial advice. Trading and investing in Bitcoin and commodities during times of war involves extreme volatility and the risk of total capital loss. Therefore, you must prioritize strict risk management, disciplined position sizing, and your own due diligence, DYOR, before making any investment. These models are probabilistic, not guaranteed, and you are solely responsible for your financial decisions and the consequences of your trades. Stay sharp, use stop losses, and never invest capital you cannot afford to lose. Now let's continue. The rule published in the Federal Register on March 30th, 2026, does not tell any plan sponsor to buy Bitcoin. It does not mention Bitcoin by name. It does not endorse any specific cryptocurrency, private equity fund, or real estate vehicle. What it does is something more precise and more consequential. It removes the single largest structural barrier that has kept institutional retirement capital out of the digital asset class for the past decade, which was not legal prohibition, but personal liability exposure. Under ERISA, the Employee Retirement Income Security Act of 1974, fiduciaries who make investment decisions that result in losses can be held personally liable for those losses. That exposure has historically made the question of whether to add Bitcoin to a 401k menu not an analytical question, but a litigation question. And most plan sponsors chose not to answer it at all. The proposed safe harbor changes that calculus by creating a presumption of prudence. A fiduciary who follows a documented review process across 6 specific factors – performance, fees, liquidity, valuation, performance benchmarks, and complexity – is presumed to have met their duty of prudence under ERISA Section 404(1)(b). The presumption does not guarantee immunity from litigation, the rule does not provide absolute protection, and the Supreme Court's removal of Chevron deference means it will receive lower judicial deference than earlier ERISA guidance. What it does provide is a documented process that shifts the question from whether a fiduciary can defend the decision to whether the fiduciary can document the analysis. And that is a meaningfully different legal environment than the one that existed on March 29th. Now let us look at the numbers honestly, because this is where the difference between what has happened and what might happen matters enormously. BlackRock's Investment Institute published a white paper in December 2024 titled Sizing Bitcoin in Portfolios that established a 1% to 2% allocation to Bitcoin as a reasonable range for a diversified multi-asset portfolio. The reasoning? In a traditional 60-40 stock and bond portfolio, a 1% to 2% Bitcoin allocation produces approximately the same contribution to overall portfolio risk as the average Magnificent 7 technology stock at its current index weight. Morgan Stanley, which filed its own spot Bitcoin ETF registration with the SEC in January 2026, and recommends a 0% to 4% Bitcoin allocation to its wealth management clients. Put the mathematics plainly, Morgan Stanley oversees approximately $8 trillion in wealth management assets, and a 2% allocation would represent $160 billion, approximately 3 times the entire size of BlackRock's IBIT at current levels. Apply that same math to the 401k market specifically. Defined contribution plan assets stood at $14.2 trillion as of December 31st, 2025, according to the Investment Company Institute. A 1% allocation from that pool equals $142 billion in potential Bitcoin demand. 2% equals $284 billion. For context, all U.S. spot Bitcoin ETFs combined have accumulated approximately $65 billion in cumulative net inflows since their January 2024 launch, a figure that the entire industry celebrated as the fastest ETF growth in financial history. 1% of the 401k market alone would represent more than twice that number. According to Bitwise's analysis published in August 2025, a 1% allocation from the defined contribution plan universe could, based on Bitcoin's historical price sensitivity to ETP flow changes, increase Bitcoin's price by approximately 63% from its baseline. The bear case here is essential and must be stated with equal precision. The rule has not been finalized. The 60-day public comment period runs through approximately June 1st, 2026. The final rule is unlikely before Q3 2026, with plan administrator implementation likely stretching into Q4 2026 or early 2027. As of 2024, only 0.1% of defined contribution plan assets were held in alternative investments of any kind, suggesting that adoption, even after finalization, will be gradual rather than immediate. Jarrett Seiberg, financial services policy analyst at TD Cowen, wrote in a research note on the day the rule was published, "The firm remains skeptical that this will encourage fiduciaries to include alternatives in 401k plans until courts have concurred that this language protects advisors from litigation, and that could take several years." The Economic Policy Institute noted that Bitcoin fell 50% from its October 2025 all-time high during the period when this regulatory process was advancing, which is not an encouraging data point for fiduciaries, evaluating volatility as one of their 6 safe harbor factors. This channel does not give price targets. What this channel does is give you the structural framework. And the structural framework says that the largest untapped pool of potential Bitcoin demand in existence just received its most credible legal pathway in history. Whether that pathway produces inflows in 2026, 2027, or 2030 depends on court decisions, plan sponsor risk appetite, and whether the final rule survives the comment period intact. What is not in question is the direction of travel. And the direction of travel is the most important variable for anyone who wants to buy Bitcoin, open a Bitcoin account, or build a long-term Bitcoin investment strategy before institutional retirement capital begins to move. There is one more number that anchors this analysis and places everything in proportion. The entire current global cryptocurrency market cap as of April 2026 sits at approximately $2.3 trillion. The total U.S. retirement market, including IRAs, 401k plans, defined benefit plans, and annuities, stands at $49.1 trillion according to the Investment Company Institute. The retirement market is approximately 21 times larger than the entire existing cryptocurrency market. When BlackRock recommends a 1 to 2% allocation, and the DOL creates the legal pathway to implement it, the conversation is not about a fringe asset trying to access a small pool of capital. It is about a fixed supply asset with 21 million coins trying to absorb demand from a capital pool that is 21 times larger than the entire digital asset universe currently combined. The math is not complicated. The timeline is uncertain. But the structural direction, when the largest asset manager in the world, the most significant regulatory development in retirement investing in a decade, and the first ever commodity classification for Bitcoin all converge in the same 30-day window, is not ambiguous. Here is the mechanism that nobody in the mainstream financial media has fully explained, and the mechanism is the reason this video is titled the way it is. Most people who have a 401k plan do not choose their investments actively. They do not sit down with a spreadsheet, evaluate expense ratios, analyze asset allocation glide paths, and select the optimal combination of equity index funds and fixed income exposure for their age and risk tolerance. Most people, when they enroll in a 401k plan, do one of two things. They either leave the default investment in place without changing it, or they are automatically enrolled into a default investment without ever making a decision at all. According to Vanguard's How America Saves 2025 report, 61% of plans now offer automatic enrollment, up from 54% in 2020. Under automatic enrollment, if an employee does not actively opt out or choose their own investments, their contributions are directed into a default investment chosen by the plan sponsor. The default investment in 94% of plans that use a qualified default investment alternative is a target date fund. A target date fund is not a single stock or a single bond. It is a fund of funds, a portfolio that holds other funds inside it, automatically rebalancing its asset allocation over time as the target retirement year approaches. If you are 30 years old and your plan defaults you into the target date 2055 fund, your money flows into that fund automatically with every paycheck. The fund starts with a high equity allocation, perhaps 90% in stocks and 10% in bonds, and gradually shifts to a more conservative mix as 2055 approaches. You do not manage this. You do not rebalance this. You may not even look at this. According to research by Cambridge professors Olivia Mitchell and Stephen Utkus published in the Journal of Pension Economics and Finance, target date fund adopters in corporate retirement plans delegated pension investment decisions entirely to fund managers selected by plan sponsors, meaning millions of Americans are invested in whatever the fund manager decides to put inside the fund. That is the mechanism. As of the end of 2025, target date fund assets reached $4.8 trillion according to Morningstar's 2026 Target Date Fund Landscape Report, a 20.3% increase over the prior year. Including custom target date strategies, the broader market exceeded $5 trillion. The four dominant providers are Vanguard, Fidelity, T. Rowe Price, and BlackRock. Vanguard dominates with approximately 37% market share and roughly $1.8 trillion in assets, with an average expense ratio of 0.08%. BlackRock manages the LifePath franchise, which holds more than $500 billion in defined contribution assets. These four providers collectively determine what the majority of Americans who default into 401k plans actually own, because the target date fund is the vehicle, and the vehicle's contents are determined by the manager, not the investor. Now here is where the regulatory architecture and the target date fund structure converge into the mechanism this video is describing. BlackRock announced in July 2025, on the firm's second quarter earnings call, that it expects to launch a proprietary LifePath target date fund with private assets in 2026. CFO Martin Small said explicitly, "Building better portfolios for retirees is at the heart of what we do. This is a place that we have particular strength and can add a lot of value, rather than just rote allocations of X% to public markets and Y% to private markets." BlackRock has already partnered with Great Gray Trust Company, which manages over $210 billion in collective investment trusts, to develop a target date fund that includes private credit and private equity alongside stocks and fixed income. Nick Nefouse, BlackRock's global head of retirement solutions and head of LifePath, confirmed the partnership publicly, stating that for too long access to private markets has been limited to institutions, leaving retirement savers behind as capital markets have evolved. BlackRock's own research, published on its institutional website, estimates that adding private equity and credit to defined contribution plans through a target date solution could boost annual returns by approximately 50 basis points, which over 40 years compounds into roughly a 15% increase in 401k savings. The critical question is, if BlackRock is already building target date funds with private equity and private credit as underlying components, and the DOL safe harbor rule now creates a legal pathway for plan sponsors to add alternative assets, including digital assets, to plan menus, how far is the logical step to a target date fund that includes a 1 to 2% allocation to Bitcoin through a regulated spot ETF? BlackRock already manages the largest spot Bitcoin ETF in the world in IBIT. BlackRock already has the LifePath franchise that manages over $500 billion in defined contribution assets. BlackRock already has the research framework recommending 1 to 2% Bitcoin allocation in diversified portfolios. And BlackRock's CFO has already said publicly that the firm is building target date funds with alternative assets in 2026. Those four facts do not guarantee a Bitcoin allocation inside LifePath, but they describe a company that has assembled every piece of the architecture required to make it happen. In the same year that the DOL published the safe harbor rule that removes the litigation barrier that was the last remaining structural obstacle. The bear case here must be stated with precision. Vanguard, which controls 37% of the target date fund market, expressed reservations about cryptocurrency and retirement plans as recently as March 30th, 2026, citing volatility concerns and lack of historical data. The 10 largest target date fund managers, as of 2022, reporting by CNBC, did not allocate to cryptocurrency. The safe harbor rule has not been finalized and will not be before Q3 2026 at the earliest. Court challenges to the rule's deference standard are anticipated, and Bitcoin fell 50% from its October 2025 all-time high during the same period that this regulatory architecture was being assembled, which is not a data point that makes target date fund fiduciaries more comfortable with volatility as a safe harbor factor. The mechanism exists. The legal pathway exists. The product infrastructure exists. Whether it activates in 2026, 2027, or 2030 depends on decisions that have not yet been made, and on a market that can always move faster or slower than the framework suggests. The most important structural signal to monitor in the months ahead is not the Bitcoin price. It is whether BlackRock files documentation with the SEC that includes Bitcoin or any digital asset as an underlying holding in a LifePath target date fund collective investment trust. That filing, if it comes, would be the moment when the mechanism this video describes moves from architectural potential to operational reality. It would mean that the next time a 25-year-old accepts automatic enrollment in their employer's 401k plan, their biweekly payroll contribution flows into a target date fund that holds a 1 or 2% position in the world's first mathematically scarce monetary asset. They will not have made a decision about Bitcoin. They will not have opened a Bitcoin account. They will not have done any research on digital gold, monetary debasement, or the M2 correlation framework. They will simply be invested, automatically, continuously compounding. In the same way their parents and grandparents were invested in American equities through the 1980s and 90s without fully understanding the mechanism that was building their wealth. The title of this video is not hyperbole. It is a description of how capital markets have always worked, and how they are about to work again. To understand what happens when a new institutional channel opens for Bitcoin, you do not need to speculate. You only need to go back 2 years to January 10th, 2024, and watch what happened in real time when the SEC approved 11 spot Bitcoin ETFs simultaneously, giving regulated institutional capital its first direct, accessible, custody-free pathway into Bitcoin at scale. Bitcoin entered 2024 trading at approximately $42,000, having rallied sharply through the second half of 2023 on the growing expectation that ETF approval was imminent. The day before the approval was announced, Bitcoin was trading near $46,000, already pricing in a significant probability that the regulatory decision would be favorable. On January 10th, the SEC approved 11 spot Bitcoin ETF applications from BlackRock, Fidelity, VanEck, Invesco, ARK, and others. Trading began on January 11th. In the first 3 days of trading, total inflows into the new spot Bitcoin ETFs reached $1.9 billion. a figure that astonished even the most optimistic ETF analysts. The largest single-day inflow by any individual ETF product was $849 million into BlackRock's IBIT in a single trading session within days of the fund's existence. What happened to Bitcoin's price in the weeks and months following the approval deserves precise examination, because the pattern contained structural lessons that apply directly to the 401k channel this video describes. Bitcoin initially dipped below $40,000 in the first 2 weeks after ETF approval, a classic sell the news reaction that caught many observers off guard. The expectation had been that the ETF channel would immediately send Bitcoin higher, and when the price dropped instead, some declared the ETF thesis falsified. What happened next was not falsification, it was lag. The institutional capital did not flow in instantly, uniformly, or predictably. It flowed in through wire transfers, through retirement account rollovers, through wealth management recommendations that took weeks to reach clients and more weeks to execute. The cumulative inflows built slowly but did not stop, and by March 14th, 2024, 63 days after ETF approval, Bitcoin had reached a new all-time high of $73,737, more than 60% above where it had been trading in the weeks before the approval. The ETF channel had, in the space of 2 months, absorbed more institutional capital than any new financial product in history and driven Bitcoin from $42,000 to $73,000. The structural mechanics of why the ETF channel had this effect matter for understanding why the 401k channel could be larger and why the timeline for its impact will be longer. When a spot ETF receives institutional inflows, each dollar of inflow must be backed by actual Bitcoin purchases, because spot ETFs hold physical Bitcoin, not futures contracts or derivatives. Every dollar that flows into IBIT means BlackRock buys approximately $1 worth of Bitcoin in the open market on behalf of the investor. Daily Bitcoin mining output following the April 2024 halving is approximately 450 Bitcoin per day, worth roughly $30 million at current prices. During peak ETF inflow weeks in early 2024, daily ETF inflows were measured in the hundreds of millions of dollars, meaning that ETF buying was absorbing multiple days of total global Bitcoin production in a single trading session. The supply and demand arithmetic of that dynamic, a fixed and slowly decreasing supply meeting accelerating institutional demand, is what drove the price from $42,000 to $73,000 in 2 months. The 401k channel is structurally different from the spot ETF channel in 3 important ways, and understanding those differences explains both why the impact could be larger and why the timeline will be significantly longer. First, the scale is different. Spot Bitcoin ETFs had accumulated approximately $65 billion in cumulative net inflows from January 2024 through March 2026, a figure that represented a new record for ETF inflows in financial history. 1% of the 401k market alone represents $142 billion, more than double total spot ETF inflows since January 2024, before a single retirement dollar has flowed in. Second, the structure is different. ETF inflows respond to market conditions, to price movements, to sentiment cycles. Retirement contributions flow automatically, biweekly, from payroll deductions through every market condition in every geopolitical environment, regardless of whether the fear and greed index reads extreme fear or extreme greed. When retirement capital enters Bitcoin through target date funds, it does not time the market. It does not react to headlines. It compounds continuously, in the same way retirement capital has compounded into equity index funds since the Pension Protection Act of 2006. Third, the speed is different. The ETF channel activated within days of regulatory approval. The 401k channel will activate over quarters and years as plan sponsors complete their fiduciary reviews, as target date fund managers update their glide paths, and as the final DOL rule provides the legal certainty that makes the documented prudence review process defensible in court. The bear case from the ETF precedent must be stated carefully. Bitcoin's 60% rally from the ETF approval to its March 24th peak was followed by a retracement. Bitcoin fell below $60,000 in the summer of 2024 and spent months below its all-time high before the Trump election rally. In November, pushed it above $100,000 for the first time. The ETF inflows did not produce a straight line higher. They produced the familiar pattern of institutional accumulation, retail capitulation, and eventual resumption of the long-term trend that has characterized every Bitcoin cycle. The lesson from the ETF precedent is not that opening a new institutional channel produces immediate and permanent price appreciation. The lesson is that opening a new institutional channel changes the structural supply and demand architecture of Bitcoin permanently, by creating a pool of long-term, non-price sensitive buyers who accumulate through every cycle rather than reacting to sentiment. The 401k channel, if it activates, would represent the largest such structural change in Bitcoin's history, larger than the ETF channel, larger than the corporate treasury channel, and deployed at a pace determined not by market sentiment, but by the mathematics of American retirement savings compounding over decades. Let us compress what this video has built into the argument it actually is, because if you have watched this far, you deserve it stated plainly. The title of this video is not a prediction. It is a description of a mechanism. The mechanism is this: 90 million Americans contribute to 401k plans. The majority of those Americans are defaulted into target date funds without ever making an active investment decision. Target date fund assets reached $4.8 trillion at the end of 2025. The four dominant managers, Vanguard, Fidelity, T. Rowe Price, and BlackRock, determine what those funds hold. BlackRock, which manages over $500 billion in defined contribution assets through its LifePath franchise and simultaneously manages the world's largest spot Bitcoin ETF in IBIT, has publicly announced it is building target date funds with alternative assets in 2026. The Department of Labor published a proposed rule on March 30th, 2026 that removes the litigation barrier preventing plan sponsors from including digital assets in 401k menus. And the SEC and CFTC jointly classified Bitcoin as a digital commodity on March 17th, clearing the legal classification that the DOL safe harbor review process requires. Every piece of the architecture is in place. Whether it activates this year, next year, or the year after depends on decisions that have not yet been made. But the direction of travel has not been clearer at any point in Bitcoin's history. Here's the bear case, stated without softening. The rule has not been finalized. Vanguard, which controls 37% of the target date fund market, has explicitly expressed reservations about cryptocurrency in retirement plans as recently as March 30th. TD Cowen analyst Jarrett Seiberg wrote on the day the rule was published that it could be several years before courts confirm the safe harbor language is legally sufficient. As of 2024, only 0.1% of defined contribution plan assets were held in any form of alternative investment, meaning even the best case scenario involves a slow, multi-year deployment of capital rather than an overnight wave. Bitcoin is currently trading near $68,000 as of April 1st, 2026, 46% below its all-time high of $126,000 set in October 2025, down from a January 26 high of over $94,000, and range-bound in the high 60s, while ceasefire signals from the Iran conflict create daily volatility in both directions. The structural case is building. The near-term price action is not. If this framework is useful to you, and you want to act on it rather than just understand it, there are three concrete things you can do right now. First, find out whether your current 401k plan already offers Bitcoin as a standalone option. Fidelity introduced the Digital Assets Account in 2022, allowing employers who opt in to offer Bitcoin exposure up to 20% of account balance. If your plan is on Fidelity's platform and your employer has adopted it, Bitcoin access may already exist in your account. Second, if your plan does not offer Bitcoin, research whether a self-directed IRA gives you the ability to hold a spot Bitcoin ETF, such as IBIT or FBTC, in a tax-advantaged account right now, without waiting for the DOL rule to be finalized, without waiting for target date funds to include Bitcoin, and without relying on any plan sponsor to make that decision for you. Third, if you already hold Bitcoin in any form, in a Bitcoin account, on a Bitcoin exchange, in a Bitcoin ETF, research Bitcoin self-custody and what it means to hold Bitcoin in a hardware wallet where no institution stands between you and your coins. The regulatory developments this video has described are positive for Bitcoin's long-term institutional adoption. They are also a reminder that every institution that holds Bitcoin on your behalf is a counterparty, and counterparties carry risk. This channel does not give price targets. What this channel gives you is the structural reading. And right now, the structural reading is that the largest untapped pool of potential Bitcoin demand in existence just received its most credible legal pathway in history, while Bitcoin is trading 46% below its all-time high, and the fear and greed index sits in extreme fear territory. What the people who have been through multiple cycles know, and what the on-chain data confirms with whale addresses, accumulating 61,568 Bitcoin in the prior 30 days at a ratio of 290 to 1 against retail selling, is that the gap between the structural case and the sentiment reading is where the opportunity lives. You have the map. The institutions already see the diamond. There's a pattern in financial history that repeats with remarkable consistency. The most consequential structural changes in how capital flows, the creation of the Federal Reserve in 1913, the approval of ERISA in 1974, the invention of the 401k itself in 1978, the Pension Protection Act of 2006 that created the QDIA framework and made target date funds the default vehicle for American retirement savings, none of these changes produced immediate, visible effects in the assets they affected. They produced slow, compounding, decades-long structural shifts in who owned what and why. The people who understood the architecture before it activated were positioned for those shifts. The people who learned about them from headlines 10 years later wondered how they missed it. The DOL rule published on March 30th, 2026 may ultimately prove to be the most important document for Bitcoin's long-term price trajectory that was published in any year, not because it immediately produced inflows, but because it completed the legal architecture that makes those inflows possible for the first time in the history of the asset. Whether you decide today to buy Bitcoin, to open a Bitcoin account, to build a Bitcoin investment strategy, or simply to keep watching the structural indicators as the framework develops, the most important thing is that you understand what is being built. Because the people who are positioned on the right side of a structural shift are almost never the ones who learned about it from a headline. They are the ones who read the architecture before it activated. That is what this video exists to provide. If you made it all the way to the end, congratulations. Seriously, that shows you're not just another casual viewer. You're someone truly disciplined, committed, and who values understanding the deeper architecture behind major shifts in capital. Very few people have that level of consistency. I'm genuinely impressed and happy when someone finishes a denser video like this one. Now, drop a comment for me. Write exactly, "I see the machine," if you understood what's being built and you're committed to this knowledge. And please don't forget to tell me where you're watching from, city and country, what time it is there right now, how the weather is over there. And one of the things I love most about creating content is realizing we're building a truly global community. People from completely different places, in opposite time zones, all seeking the same level of understanding. That motivates me a lot. I really want to read every single one of your comments. Big hug, and see you in the next video.